Last week, we had a good discussion around should you buy term and invest the difference or not? This week, we're talking how much life insurance should you actually have? This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with Net Wealth Finance.
Well, Carlo, how much life insurance should you have? And do you even think about things that way?
I don't tend to think about things this way, but a lot of people in the industry will throw out multipliers by income. So you'll hear stuff like 10 times income, 20 times income, 30 times income. And some of those things can make a lot of sense. In my opinion, the 20 to 25 times income kind of makes sense when you think about the 4% rule and not needing to touch the principal in order to maintain the principal and have some of that growth still there. These are all just ideas on how people who are really in the life insurance death benefit sales business are thinking about these things. But, I don't tend to do those calculations exactly when looking at it from the cash growth perspective.
So let's dig into this just a little bit farther at the base level. I think the reason you mentioned the 25 times income may make a difference is because usually when we're looking at an actual need for life insurance coverage, we're looking to replace an income of somebody that passed away. And if you consider the 4% rule, then 25 times the income, if a spouse gets paid that and they know how to go invest in the market so that they can follow that 4% rule, they should be able to exactly replace that income, not accounting for inflation, of course.
Yeah, and I think that's why a number like that can be a solid way to look at things if you're in this phase of life where your family is dependent on your income. Having something in that range is a reasonable thing to do.
So let's step back a bit again, and let's talk about insurable interest. The insurance company always wants to make sure they're not selling too much insurance. And the insurance agents, they get paid on how much insurance they sell. So generally, you get agents that want to sell more insurance. And so we end up in this battle where the agent needs to convince the customer that they have to buy a certain amount, and they want that to be as high as possible, but we can't go over the limits from the insurance company. And of course, the insurance companies make money off of selling death benefits. So they do want to sell the death benefit. They don't want to make it so somebody's worth more dead than they are alive. And that's where the battle comes in. There is actually a need for a lot of people to have a death benefit if they're interested in ensuring that their loved ones are in a good financial position. So let's start there and let's talk about the family. You've got a set of parents. What is normally their insurable interest?
Generally, if your parents are, if it's a dual income household and somehow both of you pass away in a car accident, you're going to want to make sure that your children, whoever's taking care of them, have the financial means to be able to take care of them.
Yeah, and the insurance company says, if you are able to provide for them at your current salary level, you most likely need a ramp of 20, 30, sometimes even 40 years of that income to ensure that your life value is still there, even though you're not.
Yes, and there's lots of considerations in that because there's impact to how your children will be impacted if they do lose both of their parents. So there's more factors than just the financial, and sometimes a little bit of extra financial can go a little way to help mitigate some of those issues that come along with that.
Yeah, there's all kinds of things to consider, and this is where you might find insurable interest in other people that aren't bringing in an income. This brings up kids. Parents can insure kids generally for up to half of what they're insured for, but kids don't bring in any income. Why would they have an insurable interest up to half of what the parents are covered for?
It's not uncommon, and this kind of connects to what I just said earlier, but if you lose a child, I think that's one of the scariest things that I can think about. We just don't know how we're going to react. And there's obviously going to be expenses with the burial and things like that. But I think the bigger impact is the potential of missed work, various things that maybe you won't even be able to perform as well as you could have in your job. Various factors that could be impacted if you do lose a child. So it can have a huge psychological impact. And that is a good reason to have some life insurance. So at least some factor is taken care of in that tragedy.
Yeah, I like how you said we just don't know how we're going to react. And some people dive into work and they'll end up working more than they ever have, and other people might not be able to work at all. So there could be a serious impact to the income that the family needs to survive because of the death of the child, even though that child was not bringing in any income. And a lot of times you'll hear people suggest that you only need insurance on people who are bringing in income because they're reliant. You have people reliant on that income. And I think they overlook that fact. And you can also extend that to a non-working spouse. A non-working spouse can get anywhere from half of what the working spouse can get, even up to equal to what a working spouse can get with some carriers.
And there's so many factors, same mental considerations there. But if you have a non-working spouse, you might not be paying for childcare that you will need to have if you lose your spouse. So there's some extra factors that can come into play if you're losing a spouse while also having children. And I think that, that's why those are what you would think of as the core insurable interests for most people, is that immediate family that you have in your household.
Exactly. Now, sometimes I get people who want to insure their children, but the children are already out of the house. They're no longer dependents. What problems do we run into in that scenario?
Well, I mean, if they're not a dependent, they should probably be getting their own life insurance and being the primary person for that consideration. And it's not it's not as clear, that insurable interest.
Now, the insurance company does view it as a lower amount of insurable interest if the parent wants to have the coverage on the child. If the child is already off living on their own, if that child passes away, it's less of a financial impact than when they're still a dependent. So you may still be able to get some insurable interest, but you're not going to be able to get a very large amount like a lot of people like to look for when we're working with them to try and get a policy that we can stuff a lot of money into. And they don't want to pay for themselves because they might think that they're too expensive. So that's usually the case where I encounter it. They say, what about my kid? Well, we're probably not going to be able to get a big enough death benefit to put a substantial amount of money into a policy. So even though they're less expensive, it just doesn't work out that way. Now, moving on from the family members there, you could also get coverage on a grandparent or a parent of yours. There is some insurable interest there, but again, that insurable interest is not going to be anywhere near what you can get on yourself when you're trying to replace an income.
In those circumstances, oftentimes it is looking to cover those expenses and various things that might be related to the estate, and having some funds that are readily available in order to handle some of those final expenses or estate-based things that aren't, could end up getting locked into probate and various factors like that. So there is an insurable interest, but it's, again, yeah, less than your immediate family would be.
Well said. Moving away from the family, if you're an employer, you can get insurable interest on key employees and business partners. And this is usually the other part that we see outside of family members. What can you get as an employer on your employee or on business partners?
So there's a thing called key person. If you have somebody who's really integral to your business and its function, that key person insurance can replace that, or maybe cover the costs of what you're going to need to do in order to replace this, you know, almost irreplaceable member of the team.
Yeah, and they take a factor of what that employee makes. So a key person, it actually has a real definition according to the IRS. It has to be a highly paid employee, meaning they make, I think it's currently over 110,000 a year. Might be different, changes a little bit every year, but essentially, depending on the carrier, they may give you 2 or 3 years worth of salary as insurable interest, or I've even seen up to 10 times the salary as an insurable interest. Now, from a business owner standpoint, you have a business partner. Now we're going to get into the business valuations because these are buy-sell agreements that we're going to look at, where if a business partner dies, they want to make sure that there's enough of a payout that the interest in the business can be purchased by one of the other partners. So they don't end up with other partners that are family members that don't really understand the business, family members of the person that died.
Yeah, and I think that's a really key point is that if you have a business, I don't know, let's say you're an attorney and you have your partner in a law firm and your spouse is in sales or some completely unrelated field and you pass away, that buy-sell agreement with the life insurance policy attached, you can buy out that spouse, the equity that would go to that spouse in order to not have this person who just has nothing to do with this business and wouldn't really be able to fill that gap. So being able to purchase out those shares is a key part of those buy-sell agreements.
Yeah. Now, the other thing to consider is sometimes beyond the value of your life based on what you can earn in your income, sometimes we look to your estate value. Certainly when we're looking to do estate planning, that might be a big factor. But sometimes people are in retirement, they don't have an income, or they may be transitioning from one job to another and they don't have an income. Then we've got to look to their net worth to see what might an insurance company allow for coverage.
Yeah, there's definitely age factors and they'll allow for some growth like 4 to 6% in that estate value and consider that for how much insurance you can get on that.
Yeah, the age factor is like they'll allow up to 20 years of compounding growth at a certain interest rate, and that may vary among carriers, but your age may play a factor. Whether you're older, they may want to limit it to when you turn 70. I think it's 70, 75, 80, somewhere around there. I don't remember the numbers exactly, but they will decide to limit it at some point. But that might be the way that you can get a bigger insurable interest that you wouldn't get when you're just considering income. Certainly for people that have large estates and not just in the case where you no longer have an actual income. So we've talked about how much life insurance you can get based on what the insurance company limits us to. But that might not be how much life insurance you should actually have. Although there's a lot of people that will make the case, if the insurance company will insure it, you should try to insure the full value of your potential life. And there is a good argument to be made there. But we're coming at this from the cash value life insurance side of things, where we're usually targeting a certain amount so that we can fund at a certain level and keep things efficient. So the question is a little bit different when it comes to us and the high cash value products that we're analyzing. When somebody says, how much insurance should I have? Where do you go with this?
I would say the minimum for the amount of money that you want to put in on an annual basis is how we design for that cash value growth. And the byproduct of that is like in my whole life policy, it still ends up being a pretty good amount of life insurance in that particular product. But that's not the goal. The goal is to have that minimum that will allow for me to get the cash into that policy at an efficient rate.
So I have a little bit of a difference whether we're looking at whole life or IUL. In whole life, when we do the designs, we can generally hit a scalable design at a lower death benefit level than we can in the IUL. So as an example, in whole life, I could potentially get you a base amount of $25,000 of insurance, blend in 10 times that much, gets us up to $250,000 in death benefit. And that might give you a MEC limit, the ability to put in $20,000 a year. And that will scale up from there. Whereas in the IUL, the minimum base I might have could be $100,000. And the scalable point is after I blend in $1 million of supplemental term. And the MEC space on that might be $60,000 a year. It might actually make sense in the IUL to get the full scalable blend, even if you're not planning on putting in $60,000, because that cost of insurance is so inexpensive to add it in now that we can build some space for the future as your income expands, or you just encounter an inheritance or some other payout that gives you a large chunk of money and you want somewhere to dump it. Having that space built in at a very low cost can allow that to happen. And it's easier to do inside of the IUL because of where we have to be at that base.
That's a really good point. And I think it is important to consider that. And I think I do approach IULs pretty similarly. And when we are looking at just it's very small amounts of costs. If you're young, if you are young, middle age, healthy, all those considerations, I think that you can have very little cost added for a giant amount of mech space that also ends up compounding. So if you can't fund it in those early years, it doesn't compound, it adds. It's not compound interest, but you can actually kind of save up that mech space to, as James said, dump in a large amount if you have some kind of windfall. So that's a really great point.
Yeah, with clients, I usually have a conversation that says, what do you think the maximum amount that you're going to put in over the next few years is? Because you don't necessarily want to start out with a mech space, a death benefit that gives you a limit that you're going to hit now, but you're going to want more space down the road. And we can usually build in a little bit of extra space when the policies first started to give you some flexibility to increase it in the near future. I usually will not recommend building in a bunch of extra space if you think it might be 10 years or so before you plan on using it. That doesn't necessarily make sense to have that added cost over that time period. You might just expand and get a different policy at that time. But if you're pretty sure that you're going to want to fund more in the near future, within the next 3 to 5 years, you might want to just build that in right at the outset. So the amount of life insurance that you should have in that scenario is going to be higher than somebody who doesn't want the ability to build in that space or add that extra funds in the near future.
Yeah, and I think that's the thing is a lot of this, it takes a conversation. I know we've talked through a number of ways to analyze things in this episode, but really it comes down to what is your individual circumstances and what your insurance needs are, but what are the amounts of money that you can project out. Maybe you're commission based, or you can see a path to big income increases. There's so many factors as to how we might approach the design. And that's why I think that it is a conversation that is the most powerful thing when we're looking at doing these types of designs.
Yeah, so how much money you're putting in is a big factor in how much life insurance we think you should have. But you might also have plans for generational wealth, in which case you're probably going to want to try to max out as much life insurance as you can get. If you look at the IRR, the internal rate of return on the death benefit, when it pays out, generally at any point earlier than age 80, it's a pretty good interest rate. So if you're getting 6, 7, 8% as a tax-free death benefit payout, where else are you going to get those types of numbers if you're just sending that money out to invest it? So if you want to guarantee some generational wealth that gets passed on, it's hard to beat those dollars that you put in and buy as an actual death benefit with life insurance. Now, with the high cash value designs we do, that death benefit, even at age 90 and 100, you're probably still pushing over 5% for an internal rate of return when that death benefit pays out. Higher in the IUL, a little bit lower in the case of whole life, but still a significant number when you consider how many decades of compounding is that from an internal rate of return standpoint. And you're just guaranteeing that you're passing that on to a loved one.
And I think that's really the power of this is when we get into this business, it is the long game. I am thinking about that generational wealth and coming up with systems that my family can carry on for even generations beyond my own children. So it is important to consider those things as you look to plan your life insurance.
That was a great discussion. We're out of time for this week. Next week, we're going to talk whole life and IULs. We're going to compare the guarantees among the two. Always an interesting topic of discussion among life insurance agents because you got people who like whole life and people who like IUL, and they generally don't meet very often. So stay tuned for that. Appreciate you joining us. My name is James Barber. I'm your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance, and we'll work with life insurance clients across the country as well.
Take care. See you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.